Five big tech names have played a major role in U.S. stock market cap weighted large cap indices for the last 2 decades. In other words, S&P 500 index returns are and have been tied to five big tech names. Our chief equity strategist and economist John Blank is here now to elaborate. First of all, John, what are these tech names and why are they so influential to the stock market?
Yeah, these are the big, multi-trillion-dollar names, Terry, that hold together 23% of the market cap of the S&P 500. So that is Microsoft, Apple, Amazon, Google. Those are the big four. You can throw Tesla in there if you want. You can sometimes throw NVIDIA in there sometimes, but those are kind of flagging stocks. It used to be Netflix was also in there, but that got pulled out. That was the FANG, FAANG. And Facebook used to be in there, but it got flagged out. So in many ways, it's down to Microsoft, Amazon, Google, and Apple.
And apparently, their underlying annual EPS growth and share price stories are quite different, yet they carry a lot of weight with the market. And any late 2022 U.S. market cap weighted stock index narrative, bearish or bullish, distills down to apparently a mega cap leadership tale. So, do you expect this to continue for yet another decade?
I don't, Terry, but the problem is, a decade's a long time, and these are now trading at 22 to 23 PEs, where stocks that are not in that group are down in the 15s. And so, one of the problems we're having here is calling bottoms in stock markets and turnings, and it really may be the case that we get a bottom out of all the other stocks but these stocks. Conversely, if you want to be bearish, we really need someone to finally throw the towel in on these stocks and really sell them off, and that would be meaningful. I don't know, if that would demonstrate they're not going to be around as leaders as companies, but it would tell you that the tone of the market will fundamentally change if that does happen.
Apparently, the biggest tech stocks are best viewed as individual businesses. And so, if that's true, won't their market influence really depend on the success of those individual businesses?
Yes, for the most part. I mean, what's really happened here, Wall Street decided to roll up and sell, more and more companies into these cash hogs and build up giant conglomerates. And so at the end of the day, we've kind of come full circle. We used to have conglomerates like General Electric and AIG, and now we've got them in tech. And but this has been a strategy that has worked for both sides of the Wall Street, which is, the M&A guys can sell deals to these groups, and the investors who buy these big companies and big stocks get a nice trade that continues to work for them year after year. So it's been a really nice trade for Wall Street.
So, what role are these big tech names playing in the current stock market downturn? Are they keeping downward pressure on the market?
No, they're keeping the market up and holding it sideways. In a quarter, the S&P is actually holding up a higher level of value than the rest of the stocks. So it's really, that's the real question here, is whether they can keep holding things up off a bottom people continue to expect, because once they go down 20, 30, 40%, then you're going to have the entire S&P look much more like typical bottoms, and that would drive the VIX up toward the 45 that everybody seems to be looking for.
Do these tech names carry the same influence over global markets and global stock indices, especially if these names are multinationals, or is it just for our stock market?
It's pretty much for our stock market. If you're looking for stocks that outside the United States that have a really big influence, you want Taiwan Semi, ticker TSM in Taiwan, and you want ASML, which is a really critical back-end chip formator in the Netherlands, ticker ASML.
And given the stock market activity right now and the current economic picture, are you looking for a hard landing?
I am looking for a pretty hard landing out of Europe, but I don't think the United States story is going to materialize for another year. I think we might be surprised just how long and aggressive the U.S. consumer is in the face of available jobs, and that we don't actually get much of a slowdown here, just a sideways motion like we're talking about, ameliorating itself through the FX depreciation, and that we just basically push this entire recession story out of here in the United States.
Is what we're seeing in the market currently the market's way of adjusting to higher interest rates and a possible recession down the road?
I think it's mostly the former and not the latter. I think it's really mostly an interest rate story. It's fascinating to realize that we're back to 2007 levels of mortgages and stuff. So that really, this might be that COVID might, in its own inadvertent way, have finally normalized the U.S. economy to some pre-09 financial crisis level. And I think that's what people need to understand here. What was abnormal was between 2009 and 2022. And what may begin to be normal is these types of interest. So I just threw out at you that the 10-year Treasury is a 4% rate. That sounds actually normal, Terry. And it's just that we haven't seen it in so long.
And what do you make of Wall Street's recent report that Wall Street Fear Guide rose to a 3-month high?
Of course it did, Terry. Stocks are selling off. And that was to be expected for September. So I think it's mainly a seasonal effect.
Okay. More strong buy stocks on your radar now include Berkshire Hathaway, JD.com, and Cadence Design Systems.
Yeah, ticker BRKB. This is Warren Buffett, of course. This is a beta of 0.9. So Buffett likes value stocks, and the beta is low. Market cap of $600 billion. It's not a huge one of those big 4 or 5 companies we talked about, but it has a big holding in Apple. So this is basically an Apple pass-through stock at this point. Gets his exact number 1 rank. Style scores of C for value, D for growth, C for momentum. Not a great story here, but actually it's in the property and casualty business where we put it, and that's actually looking pretty good because the U.S. economy from the labor market perspective is holding up pretty well. And we haven't seen a lot of loan losses yet and property losses and things like that. Interesting to see what happens after Hurricane Ian here with Berkshire, but it's only down 1.3% today on the Friday of the news out there. JD.com is basically a huge Chinese company that does online direct sales in China. It's kind of like, it's through its website. It's kind of like an Alibaba you probably didn't know about. Beta is really low, 0.3. I mean, the one thing about Chinese stocks is they're actually low beta stocks, and the value scores are excellent. Value of B, growth of A, momentum of F, and a exact rank of 1. So JD is actually in a really nice spot to pick up for a long-term hold. Cadence Design Systems, ticker CDNS. Probably don't know this one. This is out in San Jose, and they help customers design electronic products. System design enablement strategies. So this is basically helping all those chip companies out there with ideas towards their products. The beta is 1.2, the PEG ratio 2.3. Zach's ranked number 3, style score of D for value, A for growth, B for momentum. Overall, you got to like this mainly because it's such a strong performer. You can pick it up now cheaper than it's been a long time. And again, from a long-term hold perspective, you got to like CDNS.
Our chief equity strategist and economist, John Blank, keeping an eye on the market and its major influence for us. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.